In this video, we are going to study relative valuation. In fact, we already talked about it briefly in the beginning of the semester because it gives a nice introduction about what valuation is about. And then so popular, everybody uses PER and then PB ratio and that kind of things. There we started our discussion like this. Can we have some standardized measure of a stock so that we can determine easily which one is overvalued versus undervalued? Now there, our approach was to standardize our market price using some fundamental variables. So the numerator is usually a price or market cap as of today. Why? To reflect investors' perception today. And then denominator was something fundamental. Well, that is, for example, the money company made or expected to make soon in terms of accounting earnings and then things like that, the real thing that you got. And then alternatively, the money invested in the past. So the idea becomes like, how much does the market investor evaluate for now for each dollar of this fundamental in the denominator? So when you stick in the earnings per share, then the multiple becomes PE ratio. When you stick in the book value of equity per share, the multiple becomes price to book ratio. And there comes a lot of different multiples, and that's what we're going to study this video and the series of it. Now, that's relative valuation, okay? So this is kind of different from different family compared to DCF, okay? So discounted future cash flow method, you remember FCFE, FCFF, dividend discount model, and things like that. The question is, which of the following makes no sense? Number one, valuing your Samsung Electronics with DCF. Number two is valuing your apartment using DCF. Which one rather makes no sense? Actually, the second one does not make sense. Why? Well, especially sum of the part approach, okay, does not make sense when you value this apartment, because you don't do this valuation of your apartment thinking like this. Well, the cash flow that you can generate from the toilet, okay, each toilet, every month you can expect to get a certain amount of cash by holding on to this toilet bowl, okay? And then what's the cash flow that you can anticipate to generate in your living room, and then things like that, the bedroom, how much cash does it generate? Well, you don't do the valuation in that kind of discounted cash flow method when you do the apartment unit. Simply just look at the neighboring unit of apartment and see how much it was sold or bought, and that's going to be your apartment's price. That is relative valuation. We are just assuming that the asset is efficiently priced on average when we use relative valuation. This is our critical assumption. There's an abuse of language. Strictly speaking, what you get by using relative valuation is not really intrinsic value, but people sometimes just use the terminology intrinsic value even when they use relative valuation method. Now, the essence of relative valuation. In relative valuation, the object is to value assets based on how similar assets are currently priced and traded in the market. Okay? Liquidity is assumed, right? To do relative valuation, well, there are three things you have to do. Number one, identify comparable assets and obtain market values for these assets. Number two, convert these market values into a standardized value. This process of standardizing creates price multiples. Number three, compare the standardized value or multiple for the asset being analyzed to the standardized values for comparable assets, controlling for any differences between the firms that might affect the multiple. Now, most valuation on Wall Street are relative valuation. The equity analyst report, thousands of them, hundreds of thousands of reports. You see it, and then almost 85% of equity research reports are done using this relative valuation, PE ratio or PB ratio, you name it, EV to EBITDA, things like that. More than 50% of all acquisition valuations use relative valuation. Rules of thumb used based on multiples are not only common, but are often the basis for final valuation judgment. It's easy to do it with your fingers and things like that. So quite convincingly it's being used. Convenience, right? While there are more discounted cash flow valuations in consulting and corporate finance, and then this private equity kind of things, they are often relative valuations masquerading as discounted cash flow valuation. The objective in many discounted cash flow valuation is to back into a number that has been obtained by using a multiple. And the point is the terminal value is a significant number of discounted valuation is estimated using a multiple. Remember, terminal value, takes up almost 90% of your DCF valuation number, And that terminal value, well, in the textbook case that I just explained, I used golden growth model, future cash flow discounted at R minus G. But many people use PE ratio or PB ratio kind of things in that terminal value. And that terminal value takes up about 90% of your DCF valuation number. That means even though you seem to use DCF, 90% of it will come from relative valuation. So after all, we are living in a relative valuation world in that sense. So that's what we mean over here, And then a conceptual diagram about relative valuation. Let's look at it here. The timeline is on the horizontal axis, and the vertical axis shows, let's say, PE multiples at the given time point. PE multiples of many different stocks. You can sort them, right? Some stocks would have high PE ratio, some stocks would have low PE ratio. They will be distributed somehow, and there will be average or some representative number like median, things like that. The idea is like, well, let's assume this average or alternatively median, because average tends to be distorted too much by the outliers. So let's say median, alternatively, is fairly priced or efficiently priced, But at any given point of time, there must be some, upward deviation and downward deviation. We will call them overvalued stocks versus undervalued stocks. Whereas the stocks around this median or average will be assumed to be efficiently priced. So hold recommendation. Don't move. Don't try to buy it or sell it. Just stay as you are. Hold, buy recommendation, and sell recommendation. You would do it. Buy, hold, sell. Why? Our assumption is that that deviation will disappear over time, and that converges to the median. Well, that will happen in very short period of time. So you see convergence in this diagram that will happen. We are assuming it, and then you may question, well, time goes by, and what if overall average goes up? For whatever reason it may be. Maybe technological innovation, so it's a new economy got created, or all stocks turned out to be complete emotional bubble, irrational bubble. So the average stock price level or PE multiple goes up. Then what? Who cares? Who cares is the idea. Let's assume this median is always fairly priced, okay? But there will always be some stocks that are undervalued and overvalued, relatively speaking. So at any given point of time, you have some undervalued stocks or overvalued stocks in a relative sense. That's why we call this methodology relative valuation, okay? Assumption, market is efficient on average, okay? Some of the stocks may be mispriced. It will be converging to efficient level in a short amount of time, and then you just can always take long short position. Long short position, getting back to this, short position for overvalued stocks because it's going to come down to the average level. Long position for overvalued stocks. This is value investment strategy. Okay, so can we identify this kind of undervalued stock? Well, relative valuation approach assumes, yeah, always you can find this kind of things anyway. Now, most widely used valuation methods are here, okay? PE ratio, by far, this is the most popularly used, and then, it has a long history of, ever since it was created, the mother of all relative valuation, okay? That's most popularly used multiple. Next one is EV to EBITDA, okay? Enterprise value. You know what enterprise value is. The present value of your FCFF discounted at WACC, okay? And then residual income, EV to EG, DCF, PV, what's that? PB ratio, and then free cash flow to firm. All these kind of methodologies in terms of popularity are shown by the textbook author, Professor Damodaran. And then multiples are just the standardized estimates of price, okay? You can standardize either the equity value of an asset or the value of the asset itself, which goes into the numerator. So you can standardize by dividing by earnings number or book value number or revenue numbers, right? 3 different categories. You see it depending on what you stick in to the denominator. Numerator is always some market price. Why? Again, to get the idea about how much do current market investors evaluate for a given dollar of fundamentals in the denominator. So that's why market price in the numerator somehow. So earnings multiples is the first group over here. The most popular one is PE ratio. And then its variant, which is PEG ratio, PEG ratio. The second item is EV to EBIT, okay, enterprise value per dollar of operating income. And then EV to EBITDA, okay, enterprise value per each dollar of EBITDA, the operating cash flow equivalent. And then EV to enterprise value to cash flow, okay, whether it is free cash flow to firm, okay, kind of things. Now the second big group is book value based multiples. The first most popular one is PB ratio, PB. Textbooks say it's PBV or market to book equity ratio, and then EV to enterprise value to book value of assets or value to book value is another name of it. And the third is enterprise value to replacement value, which is called Tobin's Q. And the third item over here is Tobin's Q is the economist's favorite one. Why is that the case? Many different reasons, but James Tobin, okay, is an economist anyway. So, economists use this value very much. But what is more popular in the industry must be PB ratio, this guy, okay? And then third group of relative valuation method is revenues multiples, which is price to sales ratio or EV to sales ratio, okay? So those 3 groups of relative valuation, please remember. And the last group, well, asset or industry specific specific variable is also used. For example, price per click has been devised somehow, and price per customer kind of things, price per square foot when it comes to grocery stores. So the last group is much more industry specific. Okay. Now for the next video, please wait, and then we're going to delve deeper into relative valuation. Thanks for watching.